part-time, but both can still build retirement savings through the pension. The investment grows inside the plan without immediate taxation. And the main advantage of doing this is when the parents pass away, the money will transfer to the children without immediate tax on the estate. So to summarize, individual pension plans and personal pension plans are advanced tools that can provide meaningful benefits for retirement and estate planning. They generally are most effective for incorporated business owners with stable and consistent earnings. Really, family business owners are like the perfect fit in this scenario. When properly structured, registered pension plans can improve tax efficiency, strengthen estate outcomes, and support long-term succession planning goals. So for you as advisors, it's really important that you can identify clients who may have estate tax concerns, retained corporate earnings, or desire to transition wealth and business ownership to the next generation. So that's it from me. If you have any questions on any of that, please pop them into the chat and we'll go through them at the end. But for now, I'm going to hand it over to JP.
Okay, thank you, Ava, for this quick summary of the intergenerational wealth transfer features. One question I wanted to ask you or to clarify is, of course, we're talking about once both the business owner and their spouse has passed away, because just like with RSPs, if someone dies and there's a surviving spouse, then we have the ability to have all the pension assets roll over to the surviving spouse, no different than an RSP.
Yeah.
But we're trying to deal with what happens if both die.
Yeah.
Or if there was no spouse at the time of death because of a divorce or a pre-existing death or some other reason. Okay, so thank you for that. So going back to our regular agenda then, what's new in the pension world? I've got two items this month. The first one is that the Canada Pension Plan has released its latest actuarial valuation report. The Chief Actuary of Canada has to prepare these reports with a team, and it gets peer reviewed and periodically. And so the report shows that the CPP is fully funded for the next 75 years. And in fact, there is even a recommendation that the base CPP contribution rate, which is right now 9.9%, be reduced to 9.5%. And I'm bringing this up this month, not because any of us are in the business of selling CPP, but because many accountants and sometimes financial planners and people on LinkedIn or on YouTube or whatever, social media, are still to this day telling business owners, including your clients, that they should do 100% dividends when they pull money out of their corporation to live. And the basis for that recommendation is typically that this way you don't have to put any money in the CPP. And they further say that, they don't use those words, but often they do. They say the CPP is just a Ponzi scheme. And you put money in and you'll never get it back. You'll lose all your CPP premiums. Well, the fact that the latest report shows that it's fully funded for the next 75 years, which is what happened the last time the report was prepared as well, disproves this Ponzi scheme argument. The other reason why I think it's important for us in the financial community to educate entrepreneurs with respect to dividends versus salary is that, of course, if you do 100% dividend, you cannot be in a pension plan either, because you have no pensionable income. And that ties into what Ava was saying earlier about adding children. Children need to be in receipt of T4 income to join the pension plan in order to create the intergenerational wealth transfer. So if on the basis that CPP is a Ponzi scheme, a business owner rejects salaries for him or herself and the children they've just destroyed the intergenerational wealth transfer tax planning opportunity at the same time. So you see, it's all of these concepts are tied together. It's also factually wrong that you pay less tax if you take 100% in the form of dividends. At least it hasn't been true for the past 10 years. It used to be true before the federal government amended the law to increase the taxation on non-eligible dividends. But since they've done this, virtually everywhere in the country, you're actually better off with a modest salary and then the rest being dividends than 100% dividend. You pay less tax. So these dividend gurus out there are actually not helping their clients in many ways. So that's the first sort of update on what's new in the pension world. The second one is I'm going to talk a little bit about the Canada Strong Fund, this new national sovereign wealth fund that was announced by the Prime Minister, and it's gotten a bit of press. I think I mentioned it in passing during our last webinar. And, you know, this sovereign wealth fund, of course, is being criticized because unlike true sovereign wealth funds where it's made out of surplus, this one seems to be funded out of operations. So it's a bit of a misnomer. It's going to dig deeper into the deficit because it's supposed to be funded by $25 billion over 3 years. When the fund becomes live, it's supposed to be operated by an independent arm's length Crown Corporation with its own board of directors. And it's going to be investing strategically in 5 different key areas. One is clean and conventional energy. 2 is critical minerals. 3 is agriculture. 4 is advanced manufacturing, whatever that means. And 5th is transportation infrastructure. What's interesting here is that part of its mandate is also to try to work with the indigenous communities and also prioritize projects that will create high-paying union jobs. So this is a big change from the normal philosophy that has existed in Canada where the investment of pension asset is supposed to be completely arm's length from governmental oversight or governmental influence, I should say. This seems to be a back-ended way of applying some political mandates to investing. So it is a bit worrisome for those who believe that those that are entrusted with investing pension assets should operate without any political interference. So that's pretty much it there. In terms of current status, for those who are interested, there is a dedicated Canada Strong Fund Transition Office. So more bureaucracy that's been established to look after all the details, the governance, and then looking at sort of doing some market consultation about the investment parameters. So more and more will be, unless they decide to get rid of it at some point in the future, or if there's a new government. So unless that happens, more will come out later on in the news and from the government. Okay, so that's what's new in the world of pensions. The next item of our traditional agenda is what's new at Integris. So Integris is launching a new website. I've seen the mock-ups. Looks very slick, very nice. It will be both in English and in French. And it will have also some calculators some updated calculators. So I look forward to notifying the members, the attendees of when the new website becomes live. And what we will do is we will take a little bit of time in future President's Club webinars to review very briefly some of the new functionalities of the website. We would love to have some honest, candid feedback from this particular constituency to see what you think we should improve and what's missing and what can we do better so that the site is more functional and helps you in your job. So stay tuned for that, but I was pretty impressed with what I saw. So I'm really looking forward to having the new website propagated through the internet. Okay, the last part of the agenda, of course, is the questions from advisors and the case study. So Ava, were there any questions from last month that need to be answered?
No, we got through. I reached out to everyone individually to answer the questions from last month that we didn't get answered.
Okay, perfect.
I think there was only actually one or two. So yeah.
Okay, great. So case studies then. This month I've got 2 case studies to share with this team. The first one is an individual who has 2 separate occupations. On the one hand, this individual is earning a large salary from a well-established company, so an executive in a company, and of course not a shareholder of this company, just an employee, highly compensated employee. But on the side, this particular individual, based on their professional training, has started a small consulting firm. So what we call a sole proprietorship, because there's no corporation in the picture. It's just sort of like in spare time, there's some consulting being done, and of course, for the amount of time expended, the individual is billing the clients and earning additional income. Now, this individual has a spouse, and they just sent their firstborn, starting with daycare. So the mom is twirling her thumbs at home and has education, of course, and would like to do something during the day. So decided to speak to the husband about, hey, can I get paid from your consulting firm? Even though it's not an incorporated firm, it's just a side business. And so they decide to put her on salary. And the question is, can the spouse, now that the spouse is employed and receiving salary, be given access to a pension plan, an individual pension plan or a personal pension plan? Of course, the law is clear on that. Yes, because there's an employment relationship. There are services being rendered to the sole proprietorship on the consulting arm, and therefore this employee is entitled to be given access to a pension plan as part of the overall compensation mix. So what does that mean from a tax perspective? Well, first of all, the salary paid to the spouse is now a tax deduction for the sole proprietorship, which is really the husband. So it allows for for income splitting, because it reduces the total personal taxable income of the husband. Sure, the spouse has to declare taxes on her salary, but it's much lower, so that creates an income splitting phenomenon. So it reduces the overall tax burden paid by the family. And the contributions funded by the husband to her pension plan, he can't be in one because he doesn't have T4 income, but any contributions, any dollars contributed to her pension plan creates additional tax deductions for the sole proprietorship. So that means that the total tax burden is further reduced. So there's already income splitting through the payment of salary. Now we're adding even more tax relief by having some of that money go into the pension plan. So it's a nice, interesting case because there are no corporations in the picture. And typically, when people think about IPPs or even PPPs, the knee-jerk reaction is, well, there has to be a corporation. Well, there has to be a corporation if the business owner, if the shareholder wants to have a pension plan for herself or himself. But if it's just an actual employee, the employer could be a corporation, of course, could be a trust, could be a partnership, could be a sole proprietorship, could be an association, could be a not-for-profit association that doesn't pay taxes. So the universe of potential sponsors or employers is much broader than just corporations. But yet, when you surf the net and you look at the websites of people who provide for these types of solutions, virtually all the time, they make it look like, or it seems that there has to be a corporation at all times, or else no pension plan can arise. So of course, this is not true, but that's the perception out there. So that's the first case study that I thought folks might find interesting. And then the last case study this month is very interesting. It's dealing with a family corporation that's been around forever. So the parents are quite elderly now. Well, not elderly, but they're getting up in age. And this corporation was started 35 years ago. And one of the things that they did way back when is the corporation purchased a building, a commercial building. And over the years, this family business has been paying salaries to mom, dad, and the brothers and sisters. So it's a true family business. Sometimes they did that to pay for their kids' education, a little bit of income splitting, cover their tuition. Sometimes it was because they were working part-time, full-time, depending on the kid. Anyway, the point is that the corporation in question now has a buyer for this piece of real estate. And the purchase price that's on the table is around $21 million. So that creates, in this particular case, given how much money the corporation paid for the building in the first place, that creates a capital gain of roughly $16 million. And under the current tax laws, as you all know, the inclusion rate is still 50%. So 50% of $16 million is a taxable capital gain of $8 million. And right now, for an Ontario corporation, the tax is roughly 50%, 50.17%. So if we do nothing, when the corporation sells this asset, it will owe the CRA about $4 million in taxes. But their lawyer suggested that they speak to us, and so we started looking at the facts, and we said, well, you know what, if we do pension plans and RCAs, retirement compensation arrangements, we may be able to mop up some of that tax liability. And so in crunching the numbers, when you add up over 35 years, the salaries of all the family members, and you do both a pension and RCA projection, we're looking at over $8 million in tax deductions available to the corporation. So what's interesting is that even if the building were to sell, even if the corporation were to sell the building at its fair market value of $21 million, if in parallel the corporation sets up the pension plans and RCAs and funds them with the proceeds of the sale of the building, because it's corporate cash, the tax liability of $4 million would drop to zero. And of course, there'd be no tax in the hands of the shareholders either, because this is a corporate asset, not a shareholder asset. So that's part one. That's, I think, was pleasing to the client. Part two is that this particular family just turns out to be very tied to the United States. They already have extensive real estate down there. They spend most of the time down there. And after selling this asset, some of them may become non-residents of Canada, may move to the US. So the good news for this family is, of course, there's no departure tax on any money that's in both the pension plan and the RCA. So that's an interesting twist on this particular situation. So we have, therefore, two ways of protecting the family. One is by eliminating and neutralizing the tax bill on the sale of the real estate at the corporate level. The second one is for those who become non-residents, the protection from the departure tax. And if they do what Ava was talking about and structure the plan so that intergenerational wealth transfer can occur, then when the parents pass away, we will save the tax at the estate level. So they'll win a third time. So this is one of those trifecta cases where it seems that a lot of the different tools that pensions provide come into play almost all simultaneously. So I thought people might find this particular case study of interest. So that's it in terms of the formal portion of the presentation. I'm going to turn it back to Ava and we'll field some questions and then wrap it up.
Yeah. So JP, our first question is, do corporations have an alternative minimum tax?
That's a great question. I don't know the answer to that. I know individuals do. I've never looked at a corporate ATM, so I'd have to look at that.
Yeah, we can get back to you.
We can get back to the group or to the individual with that question.
Yeah. Okay, if an unincorporated professional is paying their spouse on the payroll, i.e. office manager, can they set up a pension plan for the spouse since they receive T4 income?
You want to take that one?
Yeah, so yeah, because they are paying their spouse T4 income, like JP said, they can have a pension plan set up for them as well. So then it says, can that scenario work for a sale of a family farm to an arm's length purchaser?
Yes. So for farmers, there are extra tax deductions and special treatment in the Income Tax Act with respect to, I believe, farmland and shares of qualifying farm corporations. So there are extra bells and whistles that come when you're operating a farm. But the concept is the same to the extent that you can use a pension plan to take passive assets off the balance sheet to purify and to qualify these corporations for these special exemptions, this is definitely a big aid in terms of the transaction. And since some farms are family run, the next generation is going to step into the shoes of the parents, then in the farming community, these pension plans should be the norm. Unfortunately, what we're finding out is that the financial advisors that typically help farmers have virtually no knowledge about pensions. And the accountants that are supposed to help the farmers also don't know anything about pensions. So the concept of using a pension plan in the context of a farm corporation is virtually non-existent. And that's something that we've discovered over the years. We've tried to remedy this by going to certain farming associations like the Ontario Farmers Association and some other large associations like that. But we have yet been able to get any headway in there. So it's a real disaster for farmers that they're operating without knowing any of this stuff.
Yeah, it's definitely a problem. Okay, so can a PPP work for a corp where only dividends have been paid, or an RCA and then it has ignored the PPP?
No. So if only dividends were paid and there's no decision to change that on a go-forward basis to start introducing some form of T4 income, so if someone that says, I've always done dividend, I will always do dividends, it is impossible to have a pension plan or an RCA because both are considered employment pension solutions. Therefore, then you need an employment relationship. And collecting dividends is the right of a shareholder, not the right of an employee. Therefore, the answer is no.
Yeah. And then can high T4, so 200K, less than a year-old professional corporation with $500,000 annual start the IPP?
Oh yeah, for sure. Sure,
Yeah.
that's a great salary. We don't even need that much. In fact, Ava ran for me an illustration a couple weeks ago where the salary was only $60,000. No past service, no RRSPs accumulated that we could transfer in. Just from age 45 to age 65, someone collecting a $60,000 salary. Net of our fees, after taking our fees off the top each year from the pension fund, net of our fees, this individual, by the time they turned 65, had over $250,000 more than had they just stayed in an RSP all along. So that's a $60,000 salary, and you can imagine a $200,000 salary, how much more powerful the pension plan would become.
Yeah. And then someone else wrote in, yeah, for the person that wrote in who wants a new illustration, I'll reach out to you today. And then same kind of scenario for a 47-year-old doctor, second year in practice, high income.
Yeah.
So they would also be.
For those of you who are curious, the best way is to contact Ava and say, you know what, I'm not sure this person's going to sign up. I may not even bring it to their attention, but I'm curious. He's 47, she's 47, salary's X, blah, blah, blah. Can you run a really quick back of the envelope illustration so that I get a sense of what kind of delta? Is it $250,000? Is it $1 million? Is it $2 million? Like, what is it that the pension plan can do for this person? You should feel free to email Ava all the time because that's what we do day in and day out. Sometimes it doesn't even make it to the client, but it doesn't matter. At least you develop more familiarity with the parameters of the solution, and it's easier to spot opportunities on a go-forward basis.
Yeah, yeah. So please do reach out with any cases, because we're happy to run the illustrations and run through it with you. So we have one more question. who handles the investments inside an IPP or PPP?
Well, it's the advisors. It's you guys. We don't
Yeah.
do that. It's you guys. You guys are the ones making money off of the investment, just like you would if it was an RRSP account or a tax-free savings account. It's the licensed advisor that brought the client that makes the money, not us.
Yeah, and then I guess this leads into the next question, which is how do we get paid as an advisor?
Yeah, so you get paid directly from the financial institution where the account is resident.
Yeah. And then can an IPP be varied to a PPP so that the next generation can be included?
Yes, yes. The answer is we can file a plan amendment, modify the structure, the plan text with the government, replace the old IPP rules with the new PPP rules, and then now it's easier to add younger people because they don't get penalized based on their age, right? If you're in an IPP, a traditional IPP, and you're adding an 18-year-old, a 20, a 22-year-old, the annual contributions permitted under an IPP are much lower than if they were using the PPP's defined contribution limits.
Yeah. And then can it be seg funds?
Yes, yes. If you have a life license, then the IPP can or PPP can be invested in seg funds. In fact, there are the traditional group retirement seg funds, like our friends at Industrial Alliance have been offering for 14 years. But there's also the possibility of buying a capital guaranteed seg fund, an individual seg fund contract with certain guarantees. So if the stock market tanks, the person dies, there are some contractual guarantees that the insurance carrier supplies to protect the capital. Now, those are typically more expensive because of that feature, but it is also eligible as an investment under IPP or PPP.
Yeah. Okay. Yeah, so I'll connect. So anyone who's putting in questions about connecting, I'll reach out to everyone after the webinar. But does anyone else have any other questions or anything they'd like to be clarified?
No?
I don't think so. Okay.
Good.